Welcome to the Norris Group's 13th annual I Survived Real Estate Gala. The Norris Group would like to thank the following platinum partners: Norada Real Estate Investments, San Diego Creative Investors Association, the Outspoken investor Tony Alvarez, Wilson Investment Properties, Think Realty Magazine, and Realty 411. We'd also like to thank our gold sponsors, Seven Figure Flipping, Inland Valley Association of Realtors, Keller Williams Corona, Keystone CPA Inc., Brisas Escrow, Leivas Tax Wealth Management, In a Day Development, NorCal RIA, NSD Pasadena Phoebe, Real Wealth Network, SoCal Cash Flow, Spinnaker Loans, and UDirect IRA.
Kathy, you're in the turnkey space, but I was just thinking, I love your insights on the media as well. You work with the media like I do, and they're always looking for a salacious headline. I warned people, if Trump is not the president, didn't matter if it was this year or 4 years from now, I'm expecting a wave of media to go under in the next year.
Wow.
Yeah.
Okay.
I think he has been the reason that's keeping a lot of them profitable. He's the best thing for media.
Wow.
And writing for several outlets, I have to take seminars on how to write salacious headlines. It's very clickbait, and I'm sure you get pressured a lot. I get asked about foreclosures a lot. Just real quick, I mean, you show up on these media interviews. Is there any pressure for you to write salacious headlines about our industry?
Oh my gosh. I have my degree in broadcast communications. I worked at CNN and ABC News in San Francisco and the Fox channel there. And, if it bleeds, it leads. That's the bottom line. It's a business. And Rich was just telling me that Disney bought, Fox, I think. And it's like, why would you buy Fox? Oh, it's a business. It's a business. So people forget that you've got to have eyeballs that sell. The whole idea is to bring people to have as many eyeballs as you can so you can sell them stuff. That's it. And I was in that business for years. I couldn't stand it. And I thought, I'm going to create a good news show. And you know what? Nobody wants to watch that because we are wired. Rich does this seminar every year. He's actually going to do one in January. He does it every January about how we're just, as human beings, we spend so many thousands of years trying to stay alive and wondering what's going to kill us, that, our brains are just wired that way. So it takes a lot of self-control to unwind that. And you can see it today, just people, you'd see it everywhere today.
It's going to be very interesting that just from a small business and a marketing standpoint to the algorithms, some of the decisions that some of the social media channels had played in this election and muting some voices. I think they've really run amok. It's going to be very interesting to see how they get out of this if they lose their 203 status. And I warned people early on in COVID, you are the product. Nothing's free. And when it's free, you're the product. And so, depending on what aisle you're on, it's all day, every day, one voice, you're in an echo chamber. It's scary for me just knowing how the algorithms work. It makes me sad knowing how dire situation we are, and I don't know how to fix it. It makes me sad.
I just think you are by doing education and helping people focus on what matters. And the more we can focus on our own lives and building our own businesses, it really doesn't matter what else is going on out there.
Touche. All
In
right.
my
Well,
opinion.
sorry, I wanted to take a little media side trip because I know that's your background, and you're asked to be interviewed all the time, and it's something that I'm doing a lot more. And they're like, "What's the foreclosures?" I'm like, "Nothing." there
Well,
are none to
that's
talk
it.
about.
I mean, I've gone to so many. So I've been on the set, and there's this huge visual behind me saying housing crisis. And I'm like, oh, is that what we're talking about today? Which one? The fact that there is no housing and prices are going up? I mean,
wrong housing crisis. Exactly.
Yeah, right. You're right. We got to, So.
Well, welcome to I Survive Real Estate. I thank you. You've been a longtime sponsor of this event as well. And we couldn't have got here without your support. But, you're all over the country, very interested in hearing what you're seeing from investors and the areas that you're investing in, what the sort of sense that you're getting.
Yeah, I did not provide slide this time because I figured Marco would do it for me, and he did a wonderful job because we do a lot of the same things. We have 54,000 members in our network. We have been helping people buy rental properties outside of California for 17 years now. So I really do have my finger on the pulse of other markets besides California. And I can answer any kind of question about that because we see it every day. I was just looking at the numbers. We have 200 properties in contract right now of our members rushing to buy things, selling California. It has literally been one of the busiest 6 months of our lives. I think we have 100 new members at the network every week. So it's been very fascinating to watch, just to observe what is happening. And I tell you what, in March, I'm not sure I could have predicted this, but in January I could have, and I did. So that's been interesting and feels really good to first of all be here. I admire you so much, and Bruce Norris, man, I would just wish I'd listened to you 15 years ago. I'm glad I finally found you, but I wish it were earlier. And I'm really just honored to be here.
Thank you.
Really, I just love what you guys are doing. And you actually inspired Real Wealth to do what you're doing. And we have raised $500,000 now for charity. And that's because of you guys.
Congratulations. Thank you.
Thank you. So in January, I was in front of a room of 1,000 people saying, don't get too excited about what appears to be good, because something always happens that can take us by surprise. And I even had a picture of a black swan on my screen in January, because there was so much, talk of, oh, this economy is amazing. And we were at that place again where people were making crazy decisions. I don't know if you guys know Ken McElroy, but he buys apartments, and he was selling an apartment that he had already raised the rent as high as he could get. He'd already renovated it. He's Ken McElroy. He's an expert at apartments. He wasn't messing this deal up. So he was selling it for top dollar. Well, the person who was going to buy it put together a PPM, a prospectus, and somehow it got back to Ken of somebody trying to have him invest in his own deal. And he looked at it, and basically it said, we as a group are buying this. We're going to renovate it. It hasn't been well managed. We're going to raise the rents. And, he's like, oh my gosh, I've already done all of that. They can't push these rents any further. So these kinds of things were happening. We were at that phase in the cycle. And let alone, we know that in September, the Federal Reserve was already bleeding. It was already doing quantitative easing, trying to bail out the market, creating more money very secretly, very quietly. Something wasn't quite right back then when supposedly we had such a robust market. So again, people weren't noticing those fundamentals, and it just seemed so obvious that some kind of black swan event could change everything in a moment. So when that happened, and in March, we were freaking out. We were so freaking out. We have, like I said, thousands of investors we've helped strategically buy in areas where there's population growth, where there's job growth, yet it's still affordable. And, where the demographics are going, which is very much the Southeast and Florida and Texas and Georgia, now the Carolinas. So we've been helping people doing that for a long time, but I was really afraid that maybe our plan was going to fail. We just didn't know what was going to happen. So we brought all 15 property managers that we work with across the country to figure out how are we going to get through this if people can't pay their rent, if they're losing their jobs, what are we going to do? And the property managers came up with solutions. It was amazing. Helping tenants, really the focus came to how are we going to help our tenants pay their rent when they're not either allowed to work or they can't work or they lost their jobs. I mean, this was such an unusual time to be in. And the property managers found, we all got together and said, well, let's help them make sure they know how to get their stimulus checks. Let's give them a list of jobs that are hiring. Let's tell them about charities that they can go to and get help. And April came and rents were paid, more rent collection than we'd had ever in the past. And at the same time, more applications for rent than we'd ever seen in the past. So that was weird. And we thought, okay, it's just the stimulus. Then May came, same thing. Then it was like, well, when August comes and the stimulus is gone, people aren't going to be able to pay their rent. Nope. Collections were just as high, if not higher. And Aaron, I don't know if you know this, but we also I'm a syndicator. We've raised about $140 million for residential communities across the country. just building and selling retail, not rental communities, although we're looking at the build to rent. But we raise money and we buy land and we build homes and sell them. So again, I was like, oh boy, how are we going to get through this? Same thing. I mean, it was a little scary in March and April, and then bam, we have sold more homes. Our Park City developer just called and said we've sold out completely. Our Reno project sold out. So it's been a very interesting last 6 months, but the good news is that the business that we're in is important. It's essential at a time when, when you look at the charts and the jobs that were lost, there were so many negative marks on job losses, and housing was positive. Home Depot, positive. People were spending money on their homes because home has become the new castle. You're working at home, you're teaching your kids at home, you're entertaining at home, you're cooking. Think of all the people that all of a sudden had to learn how to cook,
and that's why the divorce rate is up.
So, as far as residential, I'm just so happy. I used to be so jealous of, and I still am, Tom Wilson, these people in these big, sexy commercial projects and stuff. And I was in this boring little single family industry. And I'm so happy we are, because it really has moved up to such a high priority. We already know how, shelter, food, shelter, and clothing are essentials, right? Well, shelter moved way up high in priority. So that's a good thing.
What's been the sense that you got? I mean, since you've been having so many California investors, helping them get out, has the mood shifted? Were you experiencing the same thing from before? People were just tired of the politics, or was it just they had a good ride and they were diversifying because they didn't want to be greedy?
Well, we've been at this for 17 years, and it really started with the Real Wealth Show podcast that I've had for a really long time. And I had Kiyosaki on the show back in 2004. I was a mortgage broker at the time. And it was back then in 2005 that he taught me the fundamentals of cash flow, right? I'm being born and raised in California with a dad who's a dentist who just didn't know how to invest, and made everything he invested in didn't seem to do well, except the real estate he bought. And so I just kind of saw that and learned that and watched California prices go up. But it was Kiyosaki that said, that these loans are bad, that people can't pay them back. I knew it because I was a mortgage broker, and I could see there's no way when these reset. There was no surprise. And of course, Bruce taught this. There was no surprise about when those loans were going to reset. That was very well laid out. There were charts showing when these loans were going to reset. It should have never taken anyone by surprise. So in 2005, he was on my show saying, these loans are going to reset starting next year. People cannot pay them. It's already reached a peak. They think they can just refi, take the money, and go do it again. They're not going to be able to. So he explained how you've just got to time the markets properly. If you get into California at the right time, you can make a lot of money. If you get in at the wrong time, it's going to be a long time before you make your money back. So he was just explaining then, you can sell one property and exchange it for maybe 4 in Texas, where they're not having the same kind of bubble because they were stricter on their lending. They'd been through the S&L crisis, and Texas was not going to go through that again. So you couldn't do these crazy kind of loans there.
I'm going to have to ask a question. I'll ask it later. Marco, you got to be thinking about this tool too, the California mindset. It's not easy. California is exciting. It's a fun ride. If you were buying houses in 2009 and you're getting out now, you're sitting on a ton of equity and you're going to go to Oklahoma. Really?
Well, and and I am jealous of you guys for buying a lot of California property in 2009 when I was buying in Dallas. But at the same time, it was very boring. People were laughing at us because I did, as soon as I got off the call with Kiyosaki, I booked my flight, went to Dallas, and came home with 5 properties. And I mentioned that on the podcast, and our phone started ringing off the hook of other people who wanted to do that because they could kind of see the writing on the wall. So one woman at the time called and said, I've got these 3 properties in Stockton. They're $420,000 each. They are dilapidated, constantly in need of repairs. I bought them for retirement. I get $1,200 a month rent, but by the time I have to pay for all these repairs, I get nothing. I hate real estate. It's a terrible deal. She goes, but I heard you on the radio and I want to hear what you have to say, but I really just hate real estate. So we helped her sell those 3 properties for 1.2 million. Somebody bought them. That's the important thing to consider. Somebody thought, probably from the Bay Area, thought, I'm going to buy a $420,000 Stockton C- property and that rents for $1,200. And so someone bought those. She took her money and was able to buy 9 brand new properties right outside of Dallas for about between $120,000 and $140,000 each. They have tripled in value since. She never experienced a downturn during the great housing crisis. And in fact, she was able to quit her job immediately because her cash flow quintupled from that one transaction, that 1031 exchange, and her rents only went up during the Great Recession. So that's just kind of an example of being able to be kind of recession proof.
We're just addicted to equity in California. It's just a fun ride.
And I love it too. My parents bought a house in Atherton for $70,000 when I was in high school. I mean, it's worth, I can't even imagine now because we sold it too soon. But, there are times, it's a time, and it's like now you're probably not going to, although I have my niece is a real estate agent in the San Francisco Bay Area, and she's busier than ever. So people are still buying. They may not be renting as much. I know 2 people who manage apartments in the San Francisco Bay Area, and they've never seen the kind of vacancies they're seeing, and rents seem to be going down. But my niece is busier than ever selling houses because of those low interest rates.
Interesting. Okay. Well, Dad, you have a question before we move to our final speaker of the evening, and then we'll loop back to more Q&A?
Yeah. In 2019, we had, say, 4% unemployment, no foreclosures, a perfect market for an appreciation level over 10% in California, and we basically got nothing. So I'm just wondering what your take, and why 2020 when we have the uncertainty and we had none of it in 2019. In 2020, all of a sudden we're off to the races. Median price goes from 600 to 700, and inventory is at half the levels, and we're twice the unemployment or worse. I'm just wondering what your take is.
In California or in general?
Yeah, in California, what happened in 2019 that didn't kick all that stuff into gear?
I can't answer that, except that the only thing I can think of is in the end of 2018, when the Fed was raising rates, and that really brought the housing market in California to a screeching halt and across the country. And again, I was on TV show and radio show every day with TV hosts saying, oh, the housing crash, even though it was just a slowdown. So I think it was part media freaking people out, which kind of led into 2019 and then it was 2019 that I believe the Fed started lowering rates, and that started to stimulate the economy again. And then of course, 2020 rates are so low that for many people, I think it's just cheaper to own than to rent. It's just my guess, and it's become cheaper. And with people, a lot of people are working. A lot of people have more money because they aren't doing the massive commute to work, and they get to be home, and they can maybe move out of the city. If they can move out a little bit and to something they can afford more. Like our Reno properties, we were doing pretty good, and now it's just like the amount of people that can move to these huge homes we're building in Reno that cost $600,000 to $800,000, that would be $2 million, 3 hours away. They can go live in this beautiful place near skiing, but still, if they got to go to the office 1 day a week, they can,
Right. Okay. All right. Thank you.
Thank you, Kathy. And last but certainly not least, Neil, I got to do a great interview with you on Property Radar, and I loved your story. And you also invest in a lot of different areas, but you've got your roots in the Bay Area. I loved your story about how you got into housing and your data-driven approach, and now you're doing all kinds of fun stuff. So interested to hear what your take is on the market and some of the things you're doing in areas.
Yeah, thank you. Firstly, just delighted to be here. I have such fond memories of what was it? Was it the Carter Presidential yeah, library that we held the I survived in?
Presidential Carter.
Right? Nixon.
The
Sorry,
Nixon Library.
Nixon. That's what I said. Yeah, it was such a delightful experience, and the quality of people that come to these events is incredible. To be part of this is I really feel blessed, and also, Aaron, just developing a relationship with you and having a chance to bounce ideas off of you has been wonderful. And I know you've asked me to look at the Bay Area market and talk about some prices and really talk about the impact of telecommuting in the Bay Area market. There's obviously some urban flight going on here. I really like that because though I don't invest in the Bay Area, and it's been a while since I've invested here, the truth is that the Bay Area market is both a trendsetter and also it can be the odd man out. And also what's really fascinating to me is how the multifamily market in the Bay Area is seeing a day and night divergence from the single family market. I have never seen a divergence this high in any part of the United States at any point in the last 20 years. And so, if you know what we do, we started off very similar to what to some of the other folks that are on here in terms of buying value add multifamily. And I quickly realized that we were always chasing our tail. We were always coming in last. And so we basically switched our company from being a real estate company to be an analytics company. So now what we do is we basically look at trends to start saying, where do we go next? That's early, right? So you saw some wonderful examples from Norada on some of the markets that they're looking at, and there's no question those are good markets to look at. We made it our job to actually look at what would be the next market after that. And so we've made it our business to look 2 and 3 years out. And I'm going to talk about some of those markets today. We also started looking at asset classes. What is the next asset class? So as you can imagine, we invested in industrial. We loved it. We invested in self-storage. So we moved beyond multifamily, and we've been very delighted with that move. We started investing in an asset class that Kathy briefly mentioned. It's a very powerful asset class. I believe it is the most powerful asset class in the next 15 years. It's called build to rent. It's where you build single family homes in large communities, or you build townhomes. So people started doing single families and the financials didn't work. So now they're doing townhomes. And COVID massively accelerated build to rent because obviously people want to live in less dense areas. Townhomes have this feeling of, single family homes. So we're building now build to rent communities throughout the United States in markets that you've never heard of. None of these have been mentioned on these podcasts. And I'm looking at both their technical strength and as well as their momentum. The word momentum comes from the stock market. And we basically mash that up and come up with markets that you've never heard of. To me, the strongest market in the United States is Idaho Falls, Idaho. And there's lots and lots of reasons for that. But if you go and actually do research on Idaho Falls, you'll be stunned at just how incredibly strong this market is, especially because of the Boise effect. Then you have markets like Huntsville, Alabama, that are actually benefiting not from Alabama, but from the boom in Tennessee, the Nashville market, Memphis, Chattanooga. These markets are driving prices up, and Huntsville is actually the beneficiary. So we look at these secondary markets that are in a region that's seeing growth, and we go in and invest in those markets. The Coeur d'Alene markets is seeing a boost from Spokane. So I'll talk about that, but I'm going to start by showing you actually where the California markets stand. That's what you asked me to do. And one of the things I didn't want to do is use PowerPoint, because what's happening is I build a PowerPoint and then 30 days later, all the data is completely nonsensical because we're moving so fast. And so what I'm actually pulling is live data. So I'm going to go ahead and share my screen and pull some live data for you, right? You'll see that this data has just come out in the last few weeks. So here's the first thing I wanted to show you, right? Every market's been impacted completely differently in this pandemic. I've never seen a pandemic, or I've never seen a black swan event, and haven't been a lot of them, but the impact is so varied. Take a look at Salt Lake City. The change in employment in Salt Lake City, is just 1.5%. I flew into Salt Lake City to go to Idaho Falls, and the airport was completely packed. When I was in Oakland, right, flying to Salt Lake City, the airport was like completely empty. I mean, that was like the zombie apocalypse in Oakland, but it was perfectly fine in Salt Lake City. So you look at the difference here, just a 1.5% reduction. Austin obviously has seen a small reduction. And now we look at the cities in California, they're at the bottom, as you can imagine, right? So the maximum amount of job loss is right here. So you see Oakland here, you see San Francisco, you see Orange County, huge job losses, right? So it doesn't really matter what your job rate is today. What you want to see is how many jobs have been lost because of COVID. I think that's a much more important number than just looking at raw jobs, because that just takes you in the wrong direction. And unquestionably, California is the worst hit. Look at this: San Francisco, Oakland, Los Angeles, Orange County, all in the bottom 5% in the United States. And the markets that you're seeing at the top, no surprise there, are markets like Utah. You see Texas here, you see Arizona, and again, India actually was very interesting in how quickly it recovered. Atlanta, no surprise there. Markets in Colorado doing well. Again, San Antonio, Texas market. So when you look at the difference, look at this: 1.5%, 2%, 3% job losses. And here you're seeing 10, 11, 12%. So very diverse, this pandemic. So that's the first thing I wanted to talk about when it comes to the Bay Area. But then the Bay Area market, my home market, completely bizarre. The stuff that we're seeing in the Bay Area market. I want to show you, and Kathy mentioned this briefly. She talked about rents going down, right? I want to show you what home prices look like in that marketplace in the last few months. Let me see if I can find this here. I've got so many of these windows open. I want to make sure that I find the right one. Let's see. Boom, boom, boom.
Aaron's going to be jealous of how many screens you have.
That's right. I've got way too many at this point, actually. So let me see. Let's see. Boom. Error. All right. Well, I think I've somehow managed to lose that one screen that I had up. So give me a second. I'm going to pull it up live. So I was in bayareamarkets.com. So I'm going to just pull it up on my screen and bring it to you. So Bay Area markets at this point, every single market in the Bay Area, including San Francisco, has seen price increases on the single family market, but we've seen a divergence. As it says here, house markets still continuing to go up in every single county in the Bay Area, but condos have stalled. Why? Well, smaller amount of space. At this point, people are really, really looking for large amounts of space. And so we've seen a stall there. San Mateo County, if you look at San Mateo County, prices are increasing there. So here's San Mateo County. So you see that peak here. And as Kathy mentioned, as the Fed started raising prices, we saw drops. And then, the strong season, it came back up and then dropped again. And then at post-COVID, it's just on a tear. So I looked at every single market, every single county. We're seeing the same exact trends. The only weak market actually is San Francisco, but it's only weak for condos. So the question that Bruce asked a while back is, obviously double the unemployment, weakness in the economy. How is it that prices in the most expensive market in the US are going up? I believe that, Bruce, it's simply because people at this point are emotionally looking to buy homes. I'm talking with people here in the Bay Area. I look here and I know interest rates matter a great deal. And obviously we have these rock bottom interest rates, but I don't think that's it. I think it's the fact that at this point, home has become a castle. That statement from Kathy really resonated with me, right? Home is truly a castle. I did a full renovation. I'm not afraid of COVID. I had 70 plus workers in my house. I renovated every last inch of my house because to me, being at home meant something. I wanted to make it worthwhile. I wasn't traveling. So I renovated every single aspect of my house. I'm really happy about that. And a lot of people are doing that. Home Depots are so busy that the price of lumber in the United States is up 53% from Feb. 53%. That can't possibly be just the home builders market because it's too soon, right? Home building takes a long time. You have lots to plat. A lot of it is single family people are doing a humongous amount of work. And so we're seeing prices go up for lumber. Obviously, some of that is because of the fires that we saw in California. So it's clear that there is a psychological impact and that's driving up prices. Then the big question is, does that psychological impact last? Is it going to actually be there 3 to 6 months from now if we find a vaccine? That's the $64,000 question, but I do think that the Bay Area market may continue to rise even from here because affordability has jumped up a little bit because of the interest rates going down. In the Bay Area, a 1% reduction in loans can actually mean a huge impact to affordability. So we might see the party going on here for a while. But we are seeing very distressing trends, problematic trends in the San Francisco Bay Area. And that the first thing I wanted to show you was this trend here, suburbanization, right? This has been going on for a while. People have been talking about this in the last 6 months. They've been saying people are moving out to the suburbs. This has been going on for a while. Take a look at 2010, and this is central business district vacancy, and this is suburbs up here, central business district. The suburbs were vacant or had the highest level of vacancy ever in 2010. And notice by 2018, the suburbs had the same vacancy as central business district. We were already seeing a flight to suburbia. This clearly shows that, and it accelerated because of COVID. So what we are seeing now is, number one, we're seeing in the San Francisco Bay Area a flight to the suburbs. So we're seeing areas 40 or 50 miles away be hotter because of the concept of telecommuting, right? San Jose, San Francisco, Los Angeles are the three cities that can lose the maximum number of people in the US if telecommuting was allowed. 2 million renters could turn into homeowners in the US, and the biggest portion, San Jose, San Francisco, Los Angeles, San Diego. Not a lot of people can afford to buy simply if they're telecommuters in Jacksonville. So that's a market that people will want to go towards, but they'll want to run away from some of these top markets where telecommuting can actually, turn people into homeowners. And where do they go? Well, they either go far out into the suburbs, or they're going to go into other places like Jacksonville, Houston, Charlotte, Tampa, Atlanta. These are the markets that we really see a trend towards, and we're seeing these trends really, really accelerating in the last few months. And you can see these are polls. 42% of Bay Area workers would move if they were allowed to be remote. Now, I don't really think 42% of these people will move. But if 4.2% of the people in the Bay Area moved because telecommuting was allowed, it would change the pricing structure in single family. So I think that there's a lot of changes coming, and I'll tell you why. This is the aha moment for me. In the next 20 years, we wouldn't have trained this many CEOs around the world to run their companies remotely as we've done in the last 6 months. We couldn't have done that in 20 years with technology. So the fact that they were forced to run their companies remotely, there's going to be some converts there. So if 5% of them think that a hybrid model is better, it still changes things in expensive markets like Los Angeles and Seattle and the San Francisco Bay Area. I disagree with Tom when Tom says people will come back into the offices. I think they will. My point though is if 5% don't come back, that changes the cost structure of offices. So I think that while currently we have not seen any distress in the office market in the US, nothing, right? We've seen distress in malls, we've seen distress in retails, nothing in office. But I think in the long run, I think that strip malls will bounce back. Maybe malls won't, but strip malls will bounce back because, as he said, you still need to get a haircut, right? I think offices over the next 5 years are going to see some serious pain. That's what I believe. And the largest area of pain is going to be the San Francisco Bay Area. We saw the first major lease get cut. Pinterest paid $89 million to get out of a lease, right? This just happened a few weeks ago. I believe this is the first of many. So you're going to see a cascade of all of these things happening in the marketplace. You're also going to see a different trend. And once again, I'm going to go back to Kathy, right? She said, we're thinking about this new concept of build to rent, right? Kathy's doing build to sell because that's what makes profitable sense, no doubt about that. But build to rent, we believe, is going to become an insanely powerful asset class. This is a completely new asset class. It was really invented 2 years ago when the first REIT formed. We're going to see all across the US people building not single family homes. I think that's a fad because I don't think single family works from a rental perspective. It works the way that Kathy is doing it, where you build these things and you sell them, or you have these older buildings. But if you want to do 200, 300, 500 units, I think the single greatest trend we'll see in the next 10 years is going to be people building townhomes. Because if you can't afford a single family, if you pass beyond the point of ownership, what is the next closest thing? Well, it's a townhome. Maybe it's 3-bed, 2-bath. and it's got a nice little patio in the back and a little strip of green, and that's you're fundamentally still feeling like you're living in a single family. So we think that that's going to be the biggest explosion that we're going to see in the next 10 years. So we are following that build to rent track. The other piece that we're following is this: we believe that the time of the tertiary has come. So, a lot of people have been talking about secondary markets outperforming primaries. That's certainly the case in the last 5 years. But we think that the time of tertiary has come. We are now seeing institutional funds for the first time invest in tertiary markets, right? And I'll tell you, because I'm covering the Bay Area, I'll tell you, I'm going to take a slide from Marco Santarelli's. I screenshotted it because it's like, this guy is making my point. I'm gonna screenshot his slide. So I'm gonna pull this up on screen here. This is Marco's slide from earlier today. And he was showing the hottest markets in the US. Notice that in California, the hottest market is Fresno. Fresno is now seeing the lowest vacancy rates in its history. And it's seeing absolutely incredible home price growth. Next to Fresno is Madera, where I own 10 homes. The rent growth is just phenomenal. And that's because you're seeing basically a growth of a tertiary. There's no argument that Fresno is a tertiary. And notice that if there's one other market you pick on this graph in California, it's right here, Riverside. Once again, a tertiary. I consider it to be a tertiary, even though you can drive there from Los Angeles. But the traffic in Los Angeles is so horrible that you'd really have to look at Riverside as a tertiary. Throughout the US, we are tracking 700 markets, places you've never heard of, like Idaho Falls, places like Dalton, Georgia, the carpet capital of the US. We're seeing consistent trends of incoming money from investors that would have never invested in tertiary. Now, we don't know if this is a long-term trend, but I can tell you right now, there is a pivot that's taking place. In California, it's happening in Central Valley, and it's happening in Riverside. If you look outside, there's so many of these smaller markets. Right now, Greenville, South Carolina, one of the people, I think it was Marco, mentioned Greenville, South Carolina. That's a great market because it's on the way to Atlanta. So you go Raleigh, you go Charlotte, then you hit Greenville, then you get to Atlanta. And these corridors, we are seeing the tertiaries really, really boom. And the data is pointing to a bunch of markets that we wouldn't have invested in the last 5 years. And that's what we're seeing. A ton of that money, Aaron, is coming from the San Francisco Bay Area. Huge amounts of it coming from the Bay Area. Right now, people are taking out home equity loans simply because home prices are going up. But we do expect that market to flatten within a year. Depends on how low interest rates stay. I think this is a psychological impact. People right now want to buy homes because they're afraid. If a vaccine comes in a year from now, they may not be afraid. So I think that the boom will slow down in the Bay Area.
Thank you. And please, if people want to start sending in questions, let's do that.
Thank you for tuning in to I Survive Real Estate 2020. To watch the full video in its entirety or to learn more about speakers and sponsors, please go to isurviverealestate.com. And be sure to tune in next week for more I Survive Real Estate 2020. Thank you.